Hi, Ron. This is Jason Bjark of Wall Street from Main Street.
And this is Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 18. Now, we're recording the show on Sunday night, April 2nd, 2023. Lee, it took over a month for us to coordinate our schedules. We had to keep rescheduling to get this episode in, but there's been just so many things that have happened in the last month.
And you've been busy as anything, so everyone has been following your channel will know that you've been really busy. And yes, so many things have unfolded over the past month. I think one of the biggest stories is Silicon Valley Bank.
It's a combination of these banks, and then you kind of had an old-fashioned bank run. So you had, first off with the Silicon Valley Bank, you had them have their losses on these securities. So their bonds that they were holding, their portfolio, their loan book. Now, unless you're the Federal Reserve Bank, the Pentagon, the U.S. federal government, or a large U.S. bank like JP Morgan, and for listeners out there not familiar, the FASB, which is the accounting board here in the United States, they suspended mark-to-market accounting, but only for large U.S. banks. So like JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, those guys, they got special privileges in March of 2009. They still do not have to really mark-to-market. But if you're a smaller bank, so a regional bank, a smaller, medium-sized bank, a community bank, although Silicon Bank is pretty large relative to some of the smaller banks, but they're still much smaller than a JP Morgan, but they still have... But they still have to, but they still have to mark to market those losses. And that started kind of this whole thing here because you had basically inside information from a lot of these Silicon Valley venture capitalists. So it was Peter Thiel and what David Sachs and these guys, and they're all telling each other, they'd all been tipped off, I guess, that the bank was going to have these absolutely large losses on a lot of their investments, and they were going to mark to market the losses. And then the smarter money that had this inside information started pulling their cash out, and then that sparked off an old-fashioned bank run.
And the market disruptions continue. I mean, you want to get into commercial real estate right now? Because that ties directly into the banks.
Well, actually, I want to talk about first how you had this capital, and I think at one point it was $1.4 trillion in under 10 days. So it was an enormous amount of money. It got around social media. This was a record amount and size of a bank run because of social media. So you had all these people and emails. So you had emails and social media, text messages. People were telling each other and there was lots of people, Lee, that had way above the $250,000 limit.
Actually, we should mention what Silicon Valley Bank is and who are basically their clients. I mean, they're obviously heavily in the hedge fund space. They're also heavily involved in like Napa Valley and the wineries.
Venture capital, yeah.
Absolutely.
A lot of private equity, a lot of venture capital. There was a lot of technology companies that had cash at the bank. I believe Roku, which is like the digital content company. So they have some of their own content, but they mostly just distribute other content like Netflix and Hulu and those guys. Roku had, I think, $500 million in cash at Silicon Valley Bank.
I mean, my point is that this isn't your local community bank that you go and get a mortgage or a home or auto loan from.
No, this was kind of, they were marketing themselves as like the new type of like fast growing medium-sized bank that was going to eventually compete with the big banks. So they were intentionally trying to keep themselves below the size of JP Morgan, but they were also marketing themselves as we're going to change the way anyone does banking. And they were releasing these ridiculous commercials that were based on The Office, and they were hiring.
Did you see any of those commercials?
No, I didn't see any of them. I just heard about them. But I mean, I saw the bio for the woke meme that they hired as a risk manager. Yes. And there's no way she had enough banking experience or risk management experience to have that position. She was hired for like affirmative action quotas and for woke meme progressivism quotas. She was not hired because she has a long resume in banking and risk management and hedging out interest rate risk and duration risk on a bond portfolio. She didn't have any of that.
No, definitely not. You should definitely see the commercials. They're absolutely hysterical.
Yeah,
you're right. They were heavily into the ESG thing and just nonsense,
So that sparked off, and then that sparked off like an old-fashioned bank run. And then, of course, you had all these press releases at the U.S. Treasury and the Fed, and they flip-flopped their policies, talking about how like the FDIC limits are going to be changed, but they haven't actually fully changed them yet. They're still discussing this because if they actually ran the numbers and they were going to start guaranteeing every single bank account in the United States at 500,000 or higher, I mean the numbers backstopping that. The FDIC is severely underfunded. They'd have to go to Congress, and then the Fed would have to print it. And then the Fed would be guaranteeing, then if they guarantee every single bank account at $500, at 500,000 or more, I mean, the limits, we're talking many trillions of dollars.
Oh yeah, I mean, it's astronomical, the number of money they would have to print to cover all those losses.
And then I sent over some charts for you talking about the losses that a lot of these banks have. So they have enormous amounts of losses on their bond portfolio. And if you're a smaller bank, so a regional bank that's not the size of JP Morgan, you cannot hold all of these securities to maturity and not worry about that, like the Federal Reserve Bank that gets away with legalized accounting fraud that I talked about in my interview that I did over with Craig Hemke over on TF Metals back on last Monday. So if you're you could theoretically hold those securities, hold them to maturity, but then if you're a smaller bank and you need capital, or you have depositors start pulling out cash, then that's when the problems happen, because you then need to go raise capital. So what the Fed was doing is the Fed created a new type of bailout program, and the Fed was claiming, and Janet Yellen was claiming, that there's going to be no loss to the taxpayers. I mean, they're giving out the language of this stuff, Lee, was very similar, almost identical to the October 2019. It started a couple months before that in August 2019, the repo crisis, where they were loaning basically at par value for toxic garbage collateral. They were giving 100 cents on the dollar for stuff that was worth under 70 cents on the dollar. So they were already giving the banks a full loan at par. They were giving them at least a 20 to 30% subsidy right off the bat. Well, a lot of this stuff that the Fed is loaning at full par value, it's a subsidy, it's a bailout. It's the average person doesn't understand any of this. So the banks are already
basically like TARP 3.0, right?
They can change the name of the programs. I mean, they're in the 2019 repo crisis, the Fed's balance sheet officially expanded by $1 trillion, and they said it wasn't quantitative easing, but it was still balance sheet expansion. And the way they played things with all these bad loans and the toxic garbage they were taking as collateral, and then loaning the banks 100 cents on the dollar for this toxic sausage collateral that was worth way less than that, they just kept extending the loans and hoping people would forget about them. So I think we're going to have similar things play out. But on top of that, then we had Credit Suisse. So I've been warning about Credit Suisse for over 12 months. A lot of it was based on Archegos. But what was hidden in that bailout document there, UBS actually, and we hardly hear anyone talk about this, UBS got in writingly guaranteed loss agreements on interest rate swap derivatives from the Swiss government and the Swiss National Bank.
Well, it's interesting is UBS just announced that they're going to cut their workforce 20 to 30%.
It makes sense, because I mean, like,
absolutely, yeah.
If you have two people, if you have people at each bank, right, with the same job and they're getting paid similar salaries, you don't need both of them. No,
definitely not. Definitely not.
But those loss guarantees, I mean, the Federal Reserve Bank's going to have to backstop that, because these interest rate swaps, I mean, we don't know the numbers, the exact numbers that Credit Suisse has, but it sounds like it's really, really bad. But of course, there's not going to be any real audits, and no one's going to voluntarily issue a press release saying these loss guarantees are in writing, and Credit Suisse has, I don't know, tens of billions of dollars or hundreds of billions of dollars in losses on their interest rate swaps. They're just going to say, don't worry, little sheeple. These losses are guaranteed in writing, and your bank accounts will be fine. You can go get your devalued currency at the ATM.
I mean, this is basically a continuation. There's this snowball that was at the top of the hill, and it's rolling down the hill, and it's getting bigger and bigger, and it's a snowball of moral hazard that just continues to grow as these governments bail out, whatever they call it. They keep coming up with these programs, but all it does is increase risk for everyone.
Well, the currency swap lines open up, and then you hear a week later after Credit Suisse and UBS and the merger, then you hear problems at Deutsche Bank, which makes sense, because if there's problems in the derivatives market, the counterparties of these banks that are having problems, the other banks or other hedge funds are going to have problems too. So then the central banks are going to have to step in, or the rules are going to have to get changed. And then the currency swap lines are the easiest and most opaque way for the central banks, especially the Federal Reserve Bank, when they're doing these currency swap lines, mostly in terms of actual size. The largest ones are to the European Central Bank. and the Fed does these things and then they waive the loans. But now here we are. They already have emergency currency swap lines in an ironclad agreement with the G7 central banks, the European Central Bank. And then on top of this, Lee, they had to add daily currency swap lines.
Right. Yeah. It's going to get worse. I mean, because it's just a big house of cards that's, falls down a little bit. They rebuild it with these things, but it just gets bigger.
And speaking of houses, Lee, real estate, not houses.
Okay.
So residential real estate, there's problems. I interviewed hedge fund chief investment officer David Hay, and he was warning about the global housing bubble, how real estate prices in other countries are worse than the US right now. But he's really worried about commercial real estate here in the United States. So I think the stories that are coming out about commercial real estate, they're pretty scary. But from speaking with banking sources, and they can't go into all the details. And one of the guys I spoke to is a banker who tweets anonymously on Twitter and said he can't go into all the details because then people know it's him and he'll get fired. But he is leaking some information and routinely posting story after story about commercial real estate, trying to warn people. Is that looks like it is the next shoe to drop. And unfortunately, Lee, it looks like these smaller banks. So even though JP Morgan and Citibank and Bank of America, especially Wells Fargo, have these enormous size volume for commercial real estate, they're backstopped by the Fed. Those banks are too big to fail, and they will probably get even bigger.
Well, let's look at the long-term trend here in banking. We had the S&L crisis back in the 1980s, and they've really been trying to consolidate banking into these big mega banks. And I think this is just like the next wave that's going to hit. And the reality is that regional banks hold 70% of the outstanding property debt. And with that debt, 450 billion commercial real estate debt is due to mature in 2023 and 1.5 trillion in the next 3 years. And most of that was financed originally near 0% interest. We're not at that rate anymore. So it's going to have a tremendous impact over the next year or two.
Okay. And you add into that, Lee, much higher interest rates. So refinancing costs, interest payments on the debt are high.
Yep.
You add into that property values are lower. So a lot of these property owners, if they use large amounts of debt to buy the property and expected good cash flow to pay it off over time, the property values are down. So they're upside down on the debt.
Yeah. Well, let's talk a little bit about commercial real estate in Manhattan. One interesting statistic is you follow the MTA ridership data. It's 40% below pre-pandemic levels. That basically means that there's a lot of offices that people just are not traveling to.
Oh, yeah. Even in the Washington, D.C. metro area, and we are fairly recession proof, there's tons of empty commercial spaces, businesses, restaurants, retail shops that are failing. So there's tons.
And you look at the markets, and I've been making market comments on my YouTube community page over the past month or so, every few days or so. And we've had this rally, which was just like, it was technically due, just based on what I see. It's just a rally. I mean, it really is. It's not showing a tremendous recovery in the economy. These rallies come and go in bear markets. So I don't see how this is going to continue much longer. Maybe
the other parts of the puzzle for commercial real estate that I wanted to add there are the occupancy rates. So you have all these problems with the people who use debt to buy, either build or buy the commercial real estate space, the office buildings, the strip malls, the shopping malls, those things, right? So they use debt to buy these things, expecting a certain amount of cash flow to service their debt or pay it off, and then they'd get a return on top of that with higher rents. Well, the occupancy rates at a lot of these places are collapsing.
Absolutely.
So and it's not just all because of higher interest rates, although higher interest rates with Austrian School of Economics boom and bust, the Austrian theory of the business cycle, you had all this artificially cheap currency and credit, an artificial boom for 15 years plus around 15 years since 2008. But the higher interest rates, the Fed raising interest rates so quickly is creating the bust. And it looks like commercial real estate, unlike the last cycle in 2008, that this bust is going to be commercial real estate before residential real estate because of you have all these people are working from home.
There's no demand for it. And not only office workers, but also retail. I mean, retail is basically dying. I mean, Bed Bath and Beyond. I don't know if you've walked into one of those stores lately, but there's no inventory there.
Well, the consumer the consumer shopping more online. So if you are a retailer, it makes more sense to build a warehouse rather than a bunch of bricks and mortar retail stores for super high rents.
Following the Amazon model. So anyway, I just wanted to get back to my market here. If you pull up SLG, which is SL Green Realty, they're one of the largest holders of commercial real estate in Manhattan. And you just look at their chart, man, and you compare it to the recent market moves. They had a bump up, but my God, their chart, their stock price has basically been falling since 2015.
Is that a real estate investment trust?
They're I don't know if they're a REIT, but I know that they own and manage commercial real estate in Manhattan. They're like one of the biggest players in that space.
So right now, the commercial real estate investment trusts, they're not going bankrupt yet, but they're doing wide-scale dividend cuts. However, they were lying for months that they weren't going to have to do the dividend cuts, but it was very obvious if you did halfway decent research that those dividend cuts were going to have to come because their buildings were empty. They couldn't keep passing on higher and higher rents. You have tons of people working from home. The consumer now, after stagflation and taxes, the consumer just doesn't have as much discretionary income. I sent you some charts, Lee, showing that
by the way, yes, SL Green is a REIT. So
okay, well, and I think there's going to be bankruptcies there unless, and the Fed already kind of anticipated something like this might happen back in 2020. They set up a second permanent repo facility that almost no one is talking about. I did videos on this back in 2020, short videos showing the press releases and going into details. The second permanent repo facility is a domestic one. So there's the first permanent one for foreign central banks that was actually drawn on for $60 billion. There was a big spike on that. And Kyle Bassa said he thinks it was the People's Bank of China. I think the Swiss drew a little bit from it. So that's designed to prevent a run on the treasury market and to prevent foreigners from dumping all their treasuries at once. Instead, they can post their treasuries as collateral and then get dollars as loans. But then the domestic permanent repo facility, and this is super worrisome, the Fed set up another opaque and covert bailout facility with this domestic repo facility back in 2020. And there is, according to the bylaws, you do not have to be a bank to post collateral at this repo facility. You can be a money market. You could be a money market fund. You could be a real estate investment trust. You can be an insurance company. You could be a commercial real estate developer. You can be all these different non-bank financial entities, and you can post toxic collateral at this domestic repo facility, and the Fed will loan you par value for your toxic garbage that's not worth par value.
I think that's once again the snowball of moral hazard coming down that hill.
Yeah, so I think that's going to be our point, though, here is that we think the next shoe to drop is commercial real estate, falling commercial real estate prices, and the regional banks and the large banks start to finally mark down these losses. So it's not going to all happen right away. This thing's going to play out, Lee, over the next 6, 12, 18 months. It might play out faster than that. I mean, if you believe some of the stuff I was told by the banker, and we'll see exactly how quickly it plays out, but it sounds like these losses have been hidden for over 12 to 18 months, and that over the next couple quarters, we're going to really start to see some nasty losses and potential bank failures from these small and regional banks that have 60 to 70% of their, some of them have 60 to 70% of their loan.
Yeah, regional banks hold 70% of the outstanding property debt in the country. So
yeah, for our listeners out there who don't understand, if you're a bank and you're giving out loans, your loan book. So a lot of these small and regional banks were the ones who issued commercial real estate loan debt or small business debt. And so they have this, their loan book, which is considered an asset. But if you're paying back the debt, it's a liability. And so these assets that these bank owns, the assets that the bank owns are the debt on the property. Well, if the property values are collapsing and people are upside down in their debt that they use to get the property, and the rents are falling and they can't service the debt, they're upside down. The banks might end up with some of these properties, but the value of the properties is going to plummet. So it looks very similar to kind of what happened in the U.S. with the with the residential home bubble in 2007, before a lot of the stuff started to bust.
Yeah, the commercial real estate space back then wasn't really impacted to the same level that the habitational space was, and now we're looking at a scenario where I think both are really going to take a hit.
Well, Lee, my point was that this real estate bubble is looking similar to the residential real estate bubble in the
Right.
US in 2006, 2007, but this time it looks like it's commercial real estate with the most problems. And then we don't know the exact number of derivatives, so commercial real estate mortgage-backed securities and other shenanigans that are tied to falling commercial real estate prices. So not only will you have bad real estate loans, falling property prices, and then bank problems, you also have all the derivatives that were all tied to falling real estate prices.
Absolutely. And, there's one aspect to commercial real estate. I don't know. I'm assuming this is the same case in other cities. They've been keeping rents artificially high. Like there's so much open space to rent in Manhattan on the commercial side, so much retail space, but the rents have not fallen. And my understanding is they do that because of the covenants in the loans. So the simplest solution from an economic standpoint is when demand is low, you lower your prices. They haven't been doing it.
Except if the Fed's raising interest rates, because then you're going to default on your loan.
Yeah, but this has been going on for a long time, long before the Fed started its latest
well, actually, it depends then if the loan was a variable rate loan, if it was kind of a teaser loan, or if you locked in an interest rate. But like the other problem is you're not getting the cash flows from the higher rents that all your models, all your cash flow projections were made upon.
Right.
So you're not getting the cash flow to service the debt or pay it off. Your cash flows are collapsing, and then you're stuck with the debt. So basically then it's very similar to the residential housing bubble of the last cycle, where people are upside down on their mortgages. And then remember, the banks ended up with a lot of the properties, but the banks didn't want the property. So then the Fed had to create these new bailout programs and subsidize like BlackRock and these other large entities to go and buy entire rows of houses in Nevada, Arizona, California. And so BlackRock helped by the Fed and hedge funds, with the Fed giving them all the zero interest rate loans to go and buy these houses and set them up as rental property so prices wouldn't keep falling.
Let me ask you a question. Do you think that a very similar scenario is going to play out again?
Unfortunately, yes. And I think the large banks that are too big to fail will become even larger too big to fails. I think the large banks are already licking their chops because they have access to cheaper capital from the Fed, and they're looking to asset strip. They're already hiring away the best personnel from the small and regional banks now, because they see the crisis coming, and the bank employees at the smaller banks are all worried. So I think the larger banks are going to asset strip the best stuff, the best personnel, and the best assets from the small and regional banks. And the Fed's going to subsidize all this. So too big to fail will get even bigger.
Yes,
even more too big to fail. I was trying to come up with like it would have been bad grammar. I'm sure I'm going to get comments below the video.
The creature from Jekyll Island comes again, doesn't it?
Well, this is what happens when you have a central banking cartel that's owned by the large banks. So JP Morgan, Bank of America, Wells Fargo, Citigroup, those guys, they get much cheaper cost of capital. So if you're a credit union or a smaller regional bank, if you can get capital at all from the Federal Reserve Bank, it's going to be at super high punitive costs. So you're already behind the 8 ball. You have depositors pull their funds out of worrisome. You're in even more trouble. Your balance sheet's in peril. You have bond losses. You have commercial real estate losses. You're going to have to write these things off. There is a mess coming. I don't know the timing on this, but I'd be shocked if it takes more than 6 to 12 months. It may play out faster than that with what I'm hearing about how bad commercial real estate is right now in the US. And then you have on top of that, Lee, I sent you another chart. You have at least $600 billion of bad debt that the banks have not fully written off yet. So that's an estimate from one of the banking regulatory agencies in the US. So at least $600 billion in bad debt.
And get worse.
Well, and those, and my point here is that unless the Fed changes the accounting rules for the smaller and regional banks, those banks have to actually mark to market their losses, and their balance sheet's going to be in peril. And then they're going to need to raise capital, and those could have potential bank runs.
I saw an article today. JP Morgan expects a 21% default rate on mortgage-backed securities. I think that's just the beginning. I really do.
Are those residential? So those are regular mortgage-backed securities, or are those commercial real estate mortgage-backed securities?
It wasn't that specific. I'm assuming it was residential, but I just just making a point. I think that's a very low number based on.
Oh, yeah. Well, but I can guarantee you the Fed's going to have to buy more of it. I mean, Wall Street was still making even more of this toxic garbage, these derivatives, this toxic sausage derivatives as an income product. They were still selling it and making more of it 6, 8, 12 months ago. So the Wall Street investment banks were still chopping it up into derivatives. They're chopping up these mortgages into derivatives and then selling them off to pension funds or back to the Fed for full profits. So the Fed owns, at one point, the Fed, I think, owned around 3 trillion of these mortgage-backed securities because since 2008, 2009, they had bought so many of them and Wall Street had kept making them and the Fed had kept buying them. I think they sold off a little bit under quantitative tightening, but the Fed's balance sheet, I mean, this quantitative tightening, which really means just balance sheet reduction, I'd be shocked if there's a significant reduction in the Fed's balance sheet anymore.
Incidentally, while we were talking, an article popped up on Zero Hedge. And the title says Manhattan office vacancy hits record as marquee LA office tower sells at 50% loss.
Well, this gets
very appropriate timing.
So the Fed has distorted things so much. I actually read this great analogy in the last week or two from an article headline on Zero Hedge, and it said the Fed hits brake and accelerator at the same time. So basically, then the car is out of control and spinning and about to crash.
Yeah, of course. Hey. Central planning at its finest.
Well, the Fed is still talking about raising interest rates, but here you have, we don't know what the Fed's real balance sheet is, what's hidden off balance sheet, what's in those special purpose vehicles that are now legal as of March 2020. We don't know the real number for currency swap lines. The Fed can subjectively pick and choose winners and losers with these central banks, and they can either increase the currency swap lines and then waive the loans later. The loans do not have to get paid back. I was talking about this in my interview with Craig Hemke about a week ago, where it's not mathematically possible for the European Central Bank to have paid back tens of trillions of dollars in loans that they took out and then keep drawing the currency swap lines and paying them back. They just don't have. The European Central Bank's balance sheet had to increase massively too in the last 15 years since 2009. Their balance sheet on a percentage basis increased more than the Fed's.
All I can say is life is pretty good if you can make your own money out of thin air, you know?
Or you're a banker, you can do all these derivatives and do all these trades, and maybe you get to keep your bonuses. I mean, most of these guys are not even going to get clawbacks. So like the Silicon Valley Bank people, what they were paying bonuses, they were dumping their shares. So, I mean, that was just disgusting, the stuff they're getting away with. Hopefully their pants are sewed off from class action lawsuits. And I would prefer there's a free market solution. So I would prefer that the government doesn't create all these rules to step in, but there's tons of laws on the books for accounting fraud and all these other problems. So the laws are just not being enforced properly.
Oh, of course not. But let's face it, the government never lets a good crisis go to waste. So I am sure they will come out with some new regulations based on this. And those regulations are going to favor, who, the same big banks that get all the favoritism as they do now. So it's just more of the same.
And yet, Lee, the US dollar is still relatively strong, but you're seeing these foreign governments that are non-G7 central banks. So People's Bank of China in China, Singapore, many other governments, and they're large net buyers of physical gold in tonnage. They're buying the dip strongly. There's a big drop in the paper gold price in US dollars. These central banks are probably coming in with large tonnage orders, and they're steadily accumulating because they're not large net buyers of US treasuries. So even though retail is buying US treasuries now and they're looking at it, and retail is going into money market funds, and there's tons of hidden risk there, like during the repo crisis, although they'll probably get money market funds have been bailed out already in both 2008 and also in 2019. So money market funds will probably be bailed out, but these large countries that are running trade surpluses, they're not recycling those foreign exchange reserves into US treasuries anymore.
They're not buying anymore. Absolutely.
They're buying gold.
Yep. I mean, gold's had a nice run this first quarter. It really has.
Yeah, I think the gold bull market has just restarted. I think central banks will keep buying the dip. A lot of people are fed up with the current global financial system. I mean, clearly it's not sustainable, especially with all these bailouts, and these other countries are just fed up with it. Now, it can probably go on for another few years because there's not a viable system in place. But these other countries, they're not going to keep buying US treasuries. You're just seeing this with the numbers out of China, Japan, and Germany. They're not large net buyers of US treasuries. China and Japan sold a large amount in the last 12 months.
Yeah. I mean, we could see a pullback in gold here now, but I think we're in a bull market. I've thought that for quite some time, actually several years. We've just been consolidating. Once that gold price gets over to like 2060, forget it, man. We're going to be off to the moon. I really think that.
Yeah, and as we wrap up here, just wanted to talk about energy. So OPEC did another surprise oil production cut. Although if you check out the tweets from oil hedge fund manager Josh Young, who I've interviewed a lot over the last 12 to 18 months, he was talking about how OPEC wasn't even hitting their own production quotas. So this production cut is basically a press release reminding people that, hey, we're cutting oil production, even though they weren't even meeting their own production quotas because they're not reinvesting properly. A lot of these OPEC countries are not reinvesting into a lot of their capex bills, so they're not able to maintain and grow production. But
Jason, do you think that all the oil producing countries actually follow through on the cuts, even if they could and they were making it at where they should be? I mean, don't you think they're going to? What's that? They cheat, right?
Not as much as they used to.
Okay.
So it used to be easier to cheat. They used to have more spare production capacity.
Right.
10, 15 decades ago, they used to be able to bring on new wells faster. The Saudis used to have a lot more spare production capacity. Guar's oil field was not in decline as much. They've had to do a ton of water injection into their wells in Guar, so their costs are up a lot. Elliot Gu, I didn't call him out on this, but like he was saying how Saudi's oil production costs for their major field, Guar, are still $15. I mean, in my opinion, and I've interviewed a lot of oil experts and read oil books, that hasn't been true in at least 10, 15, 20 years. They've been water injecting their wells to maintain at least some production rates and slow the decline down. And then to replace some of the production that was lost from Guar as it depleted, they brought online much higher cost wells. So they brought online like deep water offshore wells to replace those costs. And those wells are not economic. Those deep water ones are not economic at $30 or $35, $40.
Right, yeah.
It's closer to like 50, 55. But if you add that production into their Guar production, their costs are still between $30 and $50 a barrel. It's not 10, 15, 20, 25, 30 a barrel anymore. I mean, no one really can make profits at those prices.
No.
And actually, Lee, when the oil price got down to 67, I mean, a lot of the global marginal production costs, that's like around the median average there for global marginal production costs. So there's a lot of deep water oil that's not economic at 65, 67 oil. There's a lot of higher cost shale plays in the United States outside the Permian that are not economic at those prices. And there's a lot of Canadian oil sands that are not economic at those prices or barely break even. So you were there. We're already, I mean, the natural gas price here in the United States, Lee, we're already below the production cost for most natural gas plays in the United States.
I'm not surprised at all. It's going to be interesting over the next few months, as we've been saying for a while, but things just keep getting more interesting and things happen,
Well, this is, and I've been saying this for the last couple of weeks, this is the Austrian theory of the business cycle playing out with artificial booms and busts, and the Fed rate hikes are what is causing the bust. So we had all this artificial boom, zero interest rate policy for way too long by central banks, quantitative easing, central bank balance sheet expansion for way too long. And as they raise interest rates, they don't just break things, they cause bank failures, derivative failures, they falling asset prices in this environment in a system that's over leveraged with too much debt causes, counterparty failures, derivative failures. You have the smaller banks that have to do more honest accounting because they don't get away with the stuff that the Federal Reserve Bank, the U.S. government, the Pentagon, JP Morgan, and the other large banks do with suspending mark to market. They have to mark their losses down, and that's going to create problems. So we'll see what types, and this goes back again, besides the Austrian theory of the business cycle with the booms and the busts, the artificial boom and in the bust with the rate hikes, and that exposes the malinvestment. This also brings us back to stagflate, tax slide, the lie component, Lee. What are the next series of rules changes or definitions changing? So will the FDIC, will the amount of cash in a bank account will be raised officially from 250,000 to 500,000? I mean, the numbers that were floating around, the math is just astronomically high. If they're going to guarantee, I heard at one point 2 or 3 weeks ago, they were talking about over 750,000 or even unlimited. I mean, that from a math perspective doesn't make any sense.
No, that's true. No, nothing from a math perspective makes sense anymore in the markets or in finance.
Well, the system, the central banks have the governments and central banks have distorted things so much.
Oh,
And
absolutely. I mean, you read Creature from Jekyll Island, they were talking about that a long time ago that it was going to happen, and it's been just unfolding throughout our lifetimes.
yeah, so our listeners out there are going to have to pay more attention to this. Are going to have to look around and pay attention to rules changes. So, are the smaller and regional banks, are they going to have their accounting rules changes? Are they not going to have to mark to market? Is the Fed going to create a new type of alphabet soup bailout program facility where the Fed is either buying toxic assets at 100 cents on the dollar, or in the case, which is it has already kind of happened, but similar to the 2019 repo crisis, where the Fed is giving out loans at 100 cents on the dollar with collateral that's not worth anything close to 100 cents on the dollar. I mean, some of that stuff from what I was hearing might even be worth under 30 cents on the dollar. And the Fed was giving these banks 100 cents on the dollar in loans for
it. What a world, man. Is there anything else you wanted to cover, Jason?
Well, this is end of empire type of stuff. I mean,
absolutely.
I talked about
well,
this.
I mean, you look what's going on with the dollar and the BRIC nations. I mean, we're seeing it unfold.
The end of empire stuff. There's games with the currency. The people in power, the economic and political elites in the major cities and the financial districts are spinning so many plates just to keep everything afloat, to make things look so to make the banks look solvent. They have to change the accounting laws. They have to keep changing them. They have to come up with new bailout facilities so they can make it even more opaque and even more covert. I mean, you have Jerome Powell and you have Janet Yellen saying no loss to the taxpayers and they're subsidizing the banks at least 20 or 30% on the stuff that they're loaning out at par value. So they're saying no loss to the taxpayer. Well, they're giving the banks a 20% or 30% minimum subsidy. That's a bailout to me.
Oh, no doubt about it. And let's face it. I mean, inflation isn't going away with the games they're playing. You know, it's just gonna get worse.
Well, the supply side problems, Lee. I don't know if you saw the CapEx chart I put on my Twitter or put in the Wall Street for Main Street Facebook group. I found a really good CapEx chart, and it's just showing that like the people in power at Davos, DC, Brussels, they want all this ESG spending. They want to transition people to electric vehicles. We haven't had the CapEx spending. We're just way short on copper.
Yeah.
We have the Chilean copper production, which is the Saudi Arabia of copper, and their copper mines are starting to sputter out. So we need to bring online all these new copper mines over the next 5, 10, 15 years. Well, they're way behind on that. So it's going to take a very, very long time. And then a lot of these banks won't even fund a lot of these copper projects outside of really the one in Mongolia. I think there's an enormous consortium of banks that are funding the Mongolian copper project, but the majority of banks don't want to fund copper mines.
Yeah. I mean, mining is a very risky business, as we both all know all too well.
And that's why I like the royalty and streaming companies, because they've replaced the banks over the last 10 years. They do a lot of the extra capital allocation that the banks just decided they didn't want to do. So there's a lot of people in the gold and silver community, especially these newsletter writers, that say they hate gold and silver royalty and streaming companies. Well, a lot of these mining companies, there wouldn't be supply for miners. Miners wouldn't be producing anything, or the miners would be out of business without these royalty and streaming companies, because they've stepped in and saved a lot of these mining companies.
Right.
So I would blame the banks. I would blame the bad policy that was preventing the banks from allocating capital, or the banks just decided they didn't want to allocate any more capital to mining. So and then the royalty and streaming companies, I would say, are free market. They figured out that, hey, the banks are leaving the space. The banks won't provide capital anymore. Someone else needs to come in and figure out how to provide capital to these mining companies in a win-win scenario. And these streaming contracts can be adjusted if they don't work out. They can be they can tweak the wording in the contract. Whereas with a large loan to a bank, unless you're like enormous real estate developer for many billions of dollars, I mean, the bank's probably not going to work with you and be willing to change the loan agreement too much.
Where do you think we're going here? Next couple of years, we're going to be just really, really down, right?
I think we're going to have we're having a bear market rally right now. I think things are going to rally on hope. So anytime it looks like the Fed is ending rate hikes or QE may restart, because we saw the spike in the Fed balance sheet, right? The 400 billion or something spike in the Fed balance sheet in the last week or so, that has helped fuel the stock market rally, in my opinion.
Oh yeah, I mean, I posted on my channel about a month ago saying that I was expecting an imminent rally, and it's unfolded. I don't see any signs that the rally's done yet. I think that we can pull back now, but I don't think it's over yet. But as you said, it's a bear market rally, and I think we're going to see deflation in asset prices across the board,
So we
stocks,
could,
real estate, etc.
that doesn't mean we can't have bear market rallies. I just think that we could stay in a trading range and we could be range bound. So it could be like a roller coaster kind of where we go up and then down, and then back up and then down. So I don't think the people in power, they're not just going to sit back and do nothing. Okay. It's not like the Great Depression of 1920, which is before the Fed went absolutely nuts after that, leading to the Roaring Twenties and the artificial currency and credit that led to the October 1929 bust.
Uh-huh.
The Great Depression in 1920 was really the last time where the Federal Reserve Bank didn't do anything and actually allowed bankruptcies and deflation and unemployment. And there was a really bad recession for about 18 months, but then it was over. So it cleared out everything. That was the last time the Fed didn't do anything, that DC didn't go absolutely bonkers. Actually, government cut spending in Great Depression in 1920.
Mm. Yeah, they weren't following the Keynesian model quite.
No, it was
Quite
actually
yet.
it was actually more Austrian school and free market back then.
Yeah, absolutely. So, and we're a long way from that. I mean, there's a point where the Fed is just going to be pushing on a string, and no matter what they do, it's not going to help, and the market's just going to completely collapse. And personally, I see that maybe coming in the next couple of years. I really do.
Well, I think the Fed will have to buy a lot more U.S. Treasuries, or they will have to change the laws and stuff so they can stuff the banks with more U.S. Treasuries, because foreigners are not the buyers of U.S. Treasuries. And then, if they don't get the people in power, the Keynesians, they hate deflation because there's so much debt, and that means bankruptcies, and that means loss of tax revenues. We could be looking at a scenario similar to what 1934. I don't know if it's going to look exactly like that, where the people in power decide, rather than a lot of bankruptcies and deflation, we're just going to start devaluing currencies against gold. So, or the central banks will just start accumulating enough gold, and then you'll see some honesty from some of these other central banks outside the G7 issue press releases saying that, you know what, over the last 10 or 15 years, here's the real amount of gold we bought, and our currency is more sound than the US dollar right now.
Yeah. Jason, is there anything else you think we should talk about, or should we wrap it up?
No, I think that's pretty much it. So I would avoid any of these commercial real estate trusts. Unless the Fed bails them out, they're in a lot of trouble. Commercial real estate, the loan losses for these regional banks, unless the accounting laws are changed or mark-to-market accounting is also suspended for the smaller regional banks, those are in trouble. There was a bunch of people also that were saying for many years that you need to take all your cash out of JP Morgan and Wells Fargo and Bank of America and those large banks, and you need to put all of your checking accounts and savings accounts into a credit union or a local community bank. Well, they're learning now that if those banks have bad loans and depositors pull cash, those banks do not have easy access to all the cheap capital from the Federal Reserve to keep those smaller banks, those credit unions, solvent. So,
there was a mini version of this. There was a crisis in Rhode Island with the credit unions back in the early 1990s. I don't know. Most people probably don't know about it, but it's kind of a mini version of about probably what's about to play out.
And then I was reading Danielle DiMartino Booth, her new articles about like problems with the smaller banks or regional banks, and just talking about how Dodd-Frank dumped many millions of dollars a year in extra overhead fees and compliance fees and all these costs on banks that a lot of them just couldn't afford. So what the banks just said is, we're going to merge, we're going to fire some employees, we're going to merge the banks together. So it forced even larger banks together that normally would not, because the banks were just saying basically like, all these extra compliance fees and costs and stuff are many millions of dollars that we can't afford. So we have to merge or sell out the smaller bank to a larger bank.
Well, you see that in the medical space too. I mean, there are no local doctor offices anymore. Everyone's part of some sort of medical group because they just can't afford to follow the regulations on their own as a sole proprietor.
Yep, exactly. Unfortunately, this is I'm not a big fan of government rules, regulations, red tape, because it forces costs higher. you have people overbilling insurance and the healthcare insurance. I mean, I personally have gotten tons of overbilling with healthcare insurance and doctor's visits and stuff that shouldn't be that expensive, and just tons of overbilling.
Well, the medical providers are kind of forced to do that because they have to, by law, cover everyone, especially hospitals. If someone walks into the emergency room, they have to treat them, even if they're going to lose money on it. So they have to make that money up somewhere. So they overbill everyone else as a private payer. The whole system's messed up. And it's all back. You go back to it's all government regulation. It's screwing up everything.
Amen, man. There was a specific term for that, and the healthcare insurance companies and the hospitals denied
cost shifting.
Cost shifting. Yeah, they denied that, but there's tons of examples of this happening.
There's no doubt about it. I mean, there's no way they can get around it. I mean, it's just pure economics. If you have expenses, you got to cover them. Where are you going to get the revenue from? The people are paying you. I mean, it's.
Yeah, and unfortunately, the large banks, because they have such easy cost of capital with the Federal Reserve Bank, and they're making all this extra profits with reverse repo and interest on excess reserve from the Fed. Now, they do have a lot of losses, probably in their commercial real estate loan book and other things, but they're the large banks. So if you put cash into a large bank account, you would expect that you'd be getting a pretty high interest rate based on where the Fed funds rate is. You're not.
No, absolutely. But those large banks will be able to maneuver their way through those losses much better than the small regional banks will.
Those guys are too big to fail.
Yeah,
they don't even have. They have legalized accounting fraud, like the Federal Reserve Bank, the Pentagon, the U.S. government. So
absolutely. All right, Jason. Well, it's been a great episode as always. Sorry we've had such a long time to get back together and do another episode. Hopefully, it won't be as long next time.
Yeah, I expect the next time we're on here, I think there's going to be more updates on banks. I think there's going to be more updates on commercial real estate. We may see other problems with other European banks because it looks like the dominoes are really starting to fall with Credit Suisse and then Deutsche Bank within about a week of that, once Credit Suisse was taken out by UBS and backed by the Swiss government. It's just concerning, though. You're seeing all the details out, like they had to guarantee all the losses on these interest rate swaps, and then we're not going to find out the number. No, we're never going to know.
No,
they're never going to come out.
It's a black box, man. It's all a black box.
Yeah. So I actually tried years ago to go through like annual reports of some of the large banks and see if they would disclose like actual numbers for size of interest rate swaps. The only one who does anything like that is the Bank of International Settlements twice a year.
Okay.
And that's like a rough estimate. That could be off by hundreds of trillions.
Oh yeah, no doubt about it. All right, Jason, have a great night. Thanks everyone for joining us, and please check out both our channels with our videos.
Yeah, if you want to support the channel, you can sign up for my Patreon. It's only $5 a month. I've been cranking out tons and tons of YouTube videos with my shoulder problems. It's just easier to do something with audio than typing.